Good morning and welcome to the Monday Call. I'm Stephan Clark, Chief Client Officer at NZ Funds. This year has started strongly for major share markets with the S&P 500, the Nikkei and the EuroStoxx 50 all posting double-digit returns for the first quarter. China and New Zealand stand out as exceptions. Rising commodity prices point to ongoing global growth. Although inflation is persisting more than central banks would like, it is trending down, which is fostering optimism about interest rate cuts. This optimism, in turn, is encouraging investors to look to the future, beyond current challenges, and invest in growth-orientated assets, not least Bitcoin. Simultaneously, the chorus of support for AI is growing louder. Technology firms, particularly in the United States, are making substantial investments in this sector, believing we are on the brink of a new era of productivity growth. The message is clear: innovate now or risk being left behind. This morning, we are joined by Mark Brooks, Chief Investment Officer at NZ Funds, to discuss how New Zealand Funds is positioning client portfolios to capture the opportunities while managing the risks of today's dynamic environment, and why New Zealand remains an important part of a diversified portfolio, among other exciting areas. Welcome, Mark. It's great to have you on the call again.
Thank you, Stephan. Morning, everyone.
Let's kick off with the big picture. How have markets performed so far this year, and what about the portfolios we manage?
Perfect. Start with share markets, because that's mostly what you're talking about, I'm sure. I think it's worth starting with a bit of a compare and contrast. Well, first of all, markets have been positive, which is really pleasing. And as a very big picture, I think that's part of that. We've worked through that healing process from COVID, and actually markets and economies are returning much more to normal, sort of the normal we had before COVID. And in that sense, what is normal? Probably global growth towards a 3% sort of number. So not sort of astounding growth, but not bad at the same time. So I think generally, markets have reflected that and they've been positive. I think the compare and contrast is interesting. Last year really was US dominated in terms of share markets. You had to be in the US and you had to be in the top 7 mega cap names. They dominated performance. Elsewhere was pretty lackluster. This year so far, we've seen much broader activity and much broader performance. In terms of those big mega cap names, they've still performed. There's been some divergence within that. An interesting one within that, for example, is Apple, which is a perennial performer, but it's actually down close to 10% this year. Likewise, someone like Tesla has actually struggled a lot and is down 30%, but other names within those mega caps, Microsoft, Nvidia, etc., have had stellar years. But in terms of performance, if we look across the major markets, what is striking is probably it's more similar than different. And if you go through, the US sort of being up circa 7% year to date, you go down that list and Europe is actually better than the US. Japan has been better than the US. And many across many of the different sectors, you've actually seen broader activity across the different sectors. Probably the one area which has lagged, and definitely it's sort of you see that in this part of the world, is more defensive type names, things like utilities, etc., infrastructure. Defensive names have tended to lag, and some of that's really a reflection that I suppose we've had globally. We're getting that return to growth. A lot of those names really need growth to do well. And in this part of the world, we've got some other issues like lower government spending, still got high interest rates, which are putting a cap on that growth, and we're not seeing that growth come through yet. So, in that sense, the more defensive part of the growth category has been fairly muted, but true growth has been very strong, and that's been seen in the portfolio performance. If I look at, say, as always, we tend to focus on the KiwiSaver portfolios. Is there a nice, easy way to sort of summarize returns? Over the last year, growth has really, the growth portfolio has had an exceptional period, actually, up 30% in the year to the end of March. And that has really driven wider portfolio performance. You've seen much more muted performance out of things like the inflation category and the income category. Inflation up sort of 2 and change, and income up just below 2%. What that does sort of, to a degree, highlight, though, also is that I suppose looking at different periods are important. If we look back over the last 6 months, actually much of that return across all three areas has been driven in that space. Again, sort of 30% plus performance out of the growth category. Inflation about 7.5, which is kind of what we'd expect out of that category. And then a little more muted out of income, so sort of 4.3. So more muted in that space. But look, I think it's a much longer question than you probably answer to your question than you probably expected. But I think, what that ultimately highlights, and I think something we would always try to sort of say to clients and remind ourselves of, is that, if you are actively seeing comments, say in New Zealand about recession, etc., and those comments, are part of normal conversation almost, that means it's in price. And returns like this, especially in the growth space, sort of show that, that can change very quickly, which it can be a positive.
I suppose it also, there's, contextualizing as you're doing, it's been a difficult couple of years, and then, a very strong last 6 months, and it's amazing how quickly things can change as, I guess, sentiment is obviously part of it, but it's underpinned by new data and, as we talked about at the end of last year, growth, particularly in the US, but in other sectors too, being stronger than, many market commentators and economists were forecasting at the time. Okay, so thank you for that. What do you think the main factors driving the last 6 months and that big change have been?
Look, I think it's really about what was in price. And in that sense, in many respects, and I think it's quite useful thinking here in New Zealand about probably what is in price now, given New Zealand has actually been, an underperformer in that process in terms of share markets, and really hasn't gone anywhere for about 4 years ultimately. In terms of what has changed, I think you've moved from that view that actually a hard landing, that interest rates moving up rapidly, and taking away sort of the stimulus, that would create a hard landing and quite a large recession in the US predominantly, but actually more wider across sort of Europe, the Western nations, and in New Zealand. Generally, at a global level, that probably the first step was to unwind that and talk more about a soft landing. And with that, what do we mean by a soft landing? Essentially either a mild recession or a very limited recession, and certainly one where inflation would come down. And from that point of view, a lot of the move to more positive markets was a reflection of a belief that inflation is coming, or an acknowledgement that inflation is coming down globally, and that actually the work by the central banks, it might have engineered a soft landing and we get sort of positive growth. Move forward, and probably very much sort of the end of last year and the early part of this year was actually more about moving on from that soft landing discussion almost to, is there no landing out there? Are you actually seeing strong growth? And part of this in terms of the discussion about different markets is I think you have seen better growth surprises, and you're starting, and you touched on commodities in your intro, you're starting to see more cyclical areas and asset classes start to do well, which is really that, I suppose, that next step on from building an expectation for wider growth and more GDP growth, is that you look to cyclical sectors, ones that do well during that sort of upswing in activity. And hence you're getting that more balance between technology and a more cyclical base. Defensive is still struggling. Actually, the other one I was going to point out, what has been, I think the other thing that's been very interesting in share markets, actually probably over the last year, is if you go back to just post-COVID, when interest rates were super low, we had we talk about technology as this very broad class of shares or companies that deal in technology. But actually, what you saw there was technology had very strong performance. But it was a very broad group of technology companies. It wasn't just the mega caps. It was actually a lot of what we call non-profit tech. So businesses that had a lot of promise but weren't making money today. We're going to make money in the future. And with interest rates being super low, actually $100 in 10 years' time was pretty much worth the same as $100 today. You didn't need to discount it. With interest rates moving up massively, tech came off. You saw as part of the general step back in all asset classes, reducing in value as interest rates moved higher. But what we've seen really over the last year is quite a change in the nature of technology. It's basically those businesses which have got real earnings today. And who are they? Basically, they're the mega caps, the big cap tech companies that have products, have massive cash flows. And I can't remember if I've used this one before, but if you look at something like NVIDIA, a name which is possibly not well known to the people on the street, but in investment circles is very well known. It's the third largest company in America in the S&P 500. They are expected to sell close to $100 billion of chips to data centers this year, and the margin they have on that is 72%. That says they're going to make a lot of cash. And those businesses have performed. Whereas you look at others which did well during that COVID period, but more recently, if they haven't been earning, they haven't been rewarded. A great example is the poster child from COVID, Zoom. Zoom really share price has not changed over the last 18 months, still very depressed. And why? Because ultimately, with high interest rates, earnings 10 years from now are not as attractive.
Yeah. One that immediately comes to mind when you talk about discounting future earnings is Facebook. And when Facebook listed, must have been 12 years ago, I can't remember.
Maybe a bit longer.
Yeah, even longer. That had no earnings, essentially, and was losing a lot of money. And now it's very much the opposite of that. And so investors at the time obviously had to look forward and estimate, forecast, model out what they thought the earnings profile would look like into the future. And now, of course, as we all know, Facebook's part of the Magnificent Seven and the mega cap group, which is buoying the American share market. And
actually a name like that, interesting enough, does tend to benefit from broader growth. During the COVID period and inflation, a lot of companies were able to put up price, but actually probably had to give away a little bit of volume on the back of that. As things have started to pick up, they've had that price, margins have improved, they've actually been pushing a lot of that back into more advertising in terms of the consumer staple type names, back into advertising in order to drive more of that volume and keep their price, keep their margin. Who gets that? Facebook.
Yeah. Digital advertising, and you see the other side of that, I guess, with more traditional media type struggling. Okay, that's really, really interesting. How are there particular asset classes that, other than obviously you've drawn this distinction between growth and broader based shares, are there other asset classes that you see being underpriced at the moment, be it commodities or particular commodities, or how in bonds, and also how are the share market valuations comparing with what we would have expected a year ago and 5 years ago?
Oh, there's a lot in
there. Yeah, there is a lot in there, but go for it.
I might rephrase it a little bit. I think, we're as of that sort of, and again, I'll step back. Generally our view has been that the world has been healing or has healed, and we were returning to a more normal type situation of growth, etc. And that would be positive for broad markets. As a result, portfolios, especially in the growth, portfolios across the board have been invested over the last year. We've wanted to own bonds. We've wanted to own the defensive shares. We've wanted to own the growth portfolios. And in the growth space, we've actually tended to be over-invested. So probably on average, about 110% invested. So a little levered using futures. And that was really a reflection that we did feel that you were seeing the start of a new bull market. In that sense, where is demand and supply? I think in terms of share markets, typically, many professional investors are still actually not fully invested in shares. They've become much more positive over the last 3 months or so, but allocations have still been below normal, so that's a positive. I think if we look across other markets, it's really about sort of saying, as you get that move again back to more normal growth, where is the demand and supply imbalance? And it does seem that in some respects, commodities are a key area, one in which we don't have many commodity positions. We haven't had many commodity positions, but one which we do generically like is copper. And if you think about it, there are a number of key reasons why demand and supply could be more interesting. One, China is half of global copper demand. China has been very depressed in terms of its activity, but they are encouraging more completion of their properties, etc. What happens when you complete a property? You need wiring, all those sort of things. You need appliances, which are copper heavy. So there's that demand. And also increasingly that you get the whole EV and AI process, where AI is very electricity intensive, increasing much more demand. So there seems like as we get a pickup in global growth, copper is a beneficiary of that. So that's interesting.
I might just jump in. I saw a Bloomberg chart the other day, which had 2 lines. One line was essentially investment in future commodity production and supply, and the other one was forecast demand. And there's major themes that underpin that, green revolution and AI and so forth, of course. And the gap over the last 20 years had never been wider.
Yep.
And it leaves you wondering, why has it not translated more to the price, which I guess you're essentially saying it's coming in taking the copper positions. But it's clear it's on a number of investors' minds that there is this growing gap between production or demand and supply. And, it won't, as I'm sure you're aware, it won't be unique to copper.
Yeah, I think, copper is a very industrial sensitive name. So certainly, there's been this expectation, and you're right, you've got a very large gap between the ability to supply over longer periods of time, thanks to limited investment. And, at its simplest, to take a copper mine from idea to production is probably minimum 9 to 10 years. So it's a very challenging process, as you'd expect. And from that point of view, this has been something that's been discussed a lot, probably even, certainly discussed pre-COVID. But you had that sort of, reduction in global growth that, markets like that responded. So I think that's probably why you haven't seen that price continue to push up, but we do think that's the case. I think the other one is that and I think it's important and about the way in which we think about commodities is you need to think a lot about the return profile, but also the volatility profile in terms of how volatile is the asset you own. And in many respects, a lot of commodities over long periods of time have returns which actually have not been as good as shares, but they are much more volatile. The interesting aspect, though, is that the returns they have can be quite focused, is probably the right word. You can go for months or even years with very strong returns, and then have a very long period of time where they do nothing or go backwards. Gold is probably a good example. I think at its peak, the longest downturn for gold was 28 years, where the price fell. Obviously, it's going through a very strong point at this point. We've recently seen record gold prices. And really, again, that is a demand versus supply discussion at the moment.
Righto. And so valuations. So how do valuations fare compared with, I guess, when you look backwards?
Yeah, I think one of the reasons and why have we been fully invested or over-invested in many markets is that valuations to us have looked certainly towards normal levels, average valuations, or in many cases actually quite cheap. And at a very generic level, how do we think about share markets? Essentially, we're saying, well, if we are going to buy a business, pick any business, your local cafe or something like that, if that business is making $10,000 a year and you're buying it for $100,000, or let's rephrase it, you're making $100,000 a year and you're buying it for $1 million, you're paying 10 times earnings. So, very much thinking of what multiple of earnings are we paying for here. And generally, share markets trade on a higher multiple than that, reflects the fact that you're buying very mature, stable businesses. Think a Spark or a Contact Energy in New Zealand or something like that, or a Ryman Healthcare. Very strong, mature businesses, and you have that ability to buy and sell them really fast, instantaneously, essentially. So broadly, we'd expect shares to trade somewhere between sort of 15 and 20 times earnings. Now, if we look across most markets, actually, many of those, especially outside of the US and outside of New Zealand, are either at the bottom of those sort of average valuations or actually below. So from that point of view, we've generally been that's a key reason why we've wanted to be invested, is we've felt a lot of the negative news is in price. And, this is something I've said before, but I think we're still drives a lot of our thinking in terms of cycles, is that, there is the famous quote by Sir John Templeton, founder of the Templeton Growth Fund, is that, bull markets are born in pessimism. And really that's that reflection that, when there is universal negative feeling, it will be in the price, born of pessimism. The first stage out of that, or stage two, was very much, markets move up on skepticism, or grow in skepticism. And, we've of the view that generally over the last 6, 8, 9 months, that's been the phase we've been in. Probably worth saying that given the strength of things like the US share market, it's possibly started to push into phase 3, which is sort of, growing on optimism. We're definitely not at that sort of phase 4, which is bull markets die in euphoria, where everybody wants to own them. But we are very conscious about trying to think in terms of everything that we do, what is in the price today, and where what is not being priced.
And America has obviously had a very strong run in parts of Europe, Japan too, as we mentioned. New Zealand and China, on the other hand, it's hard to say that there's even skepticism in the current, mindset of at least the media. I would say we're in a funk locally, and so how do you kind of translate what's going on overseas into what's going on locally, and where do you think it's heading?
Look, I think that's a useful transition between the point I made and the local market or the Chinese market. In the case of China, it is a market where very few people are interested, or very few outsiders are interested. And I would imagine many, I don't know this number, but many are underweight their allocation as sort of, on a global basis. If you have an all-country world index, which is the MSCI typical index at a global investment manager will use, China would make up about 4% of that. I would expect that many are underweight. And really that is a reflection that you've had a difficult time there in terms of their property market. They are going through, for want of a better word, a similar situation to sort of the US and their property market during or post the GFC. But again, I'd come back to that point, is it in the price? You look at many of the Chinese share market indices, they're down 3 years in a row. It is very rare for a major functioning share market to be down 4 years in a row. Even somewhere like Japan, which basically went through a 30-year period of deflation, falling population, never had 4 years in a row down. So again, would argue that potentially a lot of that is in the price now. And you've seen actions by the Chinese government to improve property completions, and they've got a appliance replacement program. The US had what they call their cash for clunkers. They pay people to get rid of their old cars, buy new cars. The Chinese government has an appliance version of that, again, which happens to be quite copper intensive. And flipping to New Zealand, there are reasons to possibly say this funk could continue for longer. You have a Reserve Bank who is continuing to keep interest rates high for the time being, and you have a government which is reducing spending. So, where does demand come in an economy? It basically comes from consumer demand, which is influenced by interest rates, and government demand, which in the case of the new government, they are pulling that back. So probably some reasons for it to say that funk is valid, but it's been around for a while. It's nothing new. It's no surprise to share market. We would expect that to be in the price. So, again, what is not in the price? Actually, the surprises might be the RB, Reserve Bank, cutting interest rates earlier than expected. They might be growth being better or returning to more normal. And I think in that sense, you've got to expect there is a degree of sort of pent-up demand, either at a consumer, well, maybe not so much a consumer, probably at a corporate level in terms of investment, things like that haven't happened, that given some more positivity would actually come out. So, New Zealand has been pretty sad and lackluster in terms of its performance. But at the same time, we think there are, you want to own it equally. The last point about New Zealand, as always, is why do we have an allocation to New Zealand? It's interesting in client discussions at the moment. The question I get asked is, why do you have a significant allocation across the growth portfolios, broadly about 30% to New Zealand? Question we got asked probably 5 or 6 years ago when New Zealand was doing very well relative to the rest of the world is, why do you have an offshore allocation? Why aren't you all in New Zealand? One that's clearly about diversification is that over very long periods of time, different share markets tend to all end up at the same place. And two, being in New Zealand gives you, we think New Zealand shares have two generic positives. One, they pay high dividends, so that gets you a long way to your sort of target return. And two, they're essentially tax-free in the sense of capital gains are not taxed and companies pay imputed dividends. So there is a very strong reason to be there.
Okay. Last week, the RB kept interest rates at 5.5% and had a very brief statement on
remarkably brief.
Yeah, remarkably brief. I believe one commentator said it was the briefest of all time. So an achievement. And then on Wednesday, we're going to get the CPI number out. What's your take on where that's heading? And are there any particular points, data points that you are focused on?
Does seem that CPI might be a little, well, I wouldn't say higher than expected, because generally people are expecting a number which is a bit higher than what the Reserve Bank forecast. And really that does reflect some of the activity that we've seen in things like insurances, rates, etc. So more on that service side. So the hard data itself is not showing, I don't think, that you're getting a moderation, the speed of moderation of CPI in terms of inflation that people would like. But I think the broader picture is that globally and even in New Zealand, whilst it's been slower than desired, inflation has been coming down. Again, it's probably the discussion within markets at the moment is that last mile. Can central banks get that last little bit back towards their target? And that is a question. But in the US, for example, inflation peaked at 9%. It's now 3.8%. So from that point, it's come a long way. In New Zealand, we were at 4.7. Even with a slightly stronger number, it will still come down to the mid fours or the low fours. And we are on the path to having a 3 at the front of that in some time before the end of the year. And I think my take on the Reserve Bank would be at the moment in their most recent forecast, they were expecting to cut rates March next year as their first rate cut. The market has generally been expecting that to be earlier, more sort of a September type timeframe. The very short statement and the comment that they made that suggested by the end of the year they expected to be within their 1 to 3% target does actually, to me, set the groundwork for actually making a cut and potentially that being earlier than expected. Again, from a Reserve Bank point of view, they want to make sure that inflation is within their target, but they don't want to overshoot on the other side. So if we are coming down and they have confidence that we're coming down towards those levels, there is good reason they should be able to cut rates.
Yeah. I think last time we had you on the Monday call, there was a lot of talk about immigration numbers, and there was a bit of uncertainty around retail numbers at the same time. And then since then, the retail numbers have come out, and they were depressed, more so than I think most people were expecting in spite of immigration. And at the same time, I guess the commentary around the impact that was having and the idea that it was going to supercharge or at least underpin growth in New Zealand and in turn make it harder for the RB to cut rates doesn't seem to be happening in the way that people were forecasting. Do you think that that's still a concern, or is it just the nature of the mix of the people coming into New Zealand and the spending profile that they have that is different from what some people were expecting?
Well, I think certainly you had that initial spending boost or that demand boost, and it came through probably most clearly in terms of rentals in areas like Auckland. We've seen a lot of that immigration come into. So rents, generally within the statistics department numbers, rents have been running at about a stable 4.5% level of inflation. And what has been interesting probably, and maybe we're working through that now, is that there's been this debate about, is higher immigration, yes, it creates demand, but does it reduce demand in terms of the labour force? More jobs are filled, less difference between demand and supply in terms of jobs available versus workers available. And you've definitely seen quite a moderation in terms of the employment side in New Zealand. It's getting it does seem it's getting much harder to find a job. And in terms of the quarterly survey of business opinion, go back a year, ability to find staff was by far the most pressing concern. Now that's about fourth or fifth on the list. The other interesting parallel is you're actually seeing a very similar dynamic in the US. US has seen very strong immigration. As a result, they've actually seen strong job numbers. Even though with high interest rates, you would expect their job growth to roll off, but it hasn't. It's continued to be quite strong. But what has rolled off is their wage inflation. And that is, again, coming down in a way which suggests that it is that additional workforce which is just dampening inflation in the wage part. So I think in New Zealand, the other aspect we do have is the government's recently announced they're going to make some changes to that immigration aspect. So that would suggest that potentially one, you've had more workers come into the economy, you've got less wage pressure, which is good from an RB perspective, and potentially that additional stimulus coming forward is actually going to sort of dissipate a bit. So, if I was sort of sitting there at the Reserve Bank, you go, well, I know my wage concerns are better, certainly better than they were. I know the government's spending less. I know that the impact of my previous interest rate rises are clearly having an impact. That sets up a situation where I think they can take their foot off the brake.
Yeah, okay.
So maybe that's the surprise in that sense for New Zealand shares.
It would be a nice surprise for mortgage holders.
Exactly.
There's a lot of talk about government spending, and you touched on that a couple of times. And you can't have a conversation about government spending without having a conversation about debt levels.
Yep.
And universally, depends what side of the field you sit on. If you, some will point to the fact that debt levels have grown markedly over recent years, and particularly in the post-COVID world. And then the other side will point to the fact that relative to other developed nations, debt levels are very, very low, and there's a lot of headroom, a huge amount of headroom for more government spending and infrastructure and so forth. What's your take on the importance of that conversation and how that's going to translate, particularly to the share market and investors' outcomes?
Yeah. A couple of answers. One, generally governments around the world have been spending more and, frankly, still have a mandate to do that. So you are seeing, I think, from a bond point of view, more bond issuance from governments. And from our point of view, that we would expect, continue to keep longer-term interest rates higher. Things like the Reserve Bank may cut interest rates, but it puts pressure on longer-term interest rates to remain higher. But I think, the interesting bit about government debt is actually that issue of context, of trying to sort of say, well, do I actually understand what this number means? In New Zealand's case, we have $71 billion or ballpark worth of net debt, net government debt. That's a really big number. But the question is it relative to what the government does? And I think, one of the ways in which I try and think about it is say, well, try and bring it back to an individual example. So, one of the best ways to think about it is the Reserve Bank has been discussing debt to income ratios as a way to measure their ability to control the bank lending in the economy. And they've essentially said that a debt to income limit of 6 times they think is an appropriate level. So to put that in context, if you're earning $100,000, means the maximum the Reserve Bank rules would let you borrow from a bank would be $600,000. To most people, especially if you live here in Auckland, $600,000 mortgage is probably not that scary. Now, if we look around the world, interestingly, places like the US is probably on about 3 times debt to income. They do seem to take in less government income, so that's probably a slightly different discussion. But, there are some question marks over that. Would the US ever default? No. Ultimately, a government won't default because it can just print money. But in terms of New Zealand, that's $71 billion. How does that compare? Well, the simple answer is that New Zealand government income is $150 billion a year. So from that point of view, debt is less than half. It's about 0.47 times income. So rather than being 6 times, it's only half. It's less than 1 time. And so bringing that back to that individual example, if you were earning $100,000 a year, essentially that $71 billion comes back to an effective $47,000 worth of debt. Not particularly scary from that point of view. And likewise, I think, from memory, government interest payments last year were about net interest payments were about $3.5 billion. Bring that back to the $100,000 example, that's about $2,500 of interest. Equally, not particularly scary. So, to me, there is questions over how that debt, what it's being spent on. And, again, the simple answer would be, from my point of view, is why do you want to take on debt? Ultimately, It's to invest into an asset that will deliver, that will earn more. And, from a New Zealand point of view, if the government's going to take on more debt, they should be doing that in a way which earns them more than essentially it costs them. One of the arguments might be that, debt has risen from a net of 5 billion to 71 billion. How that was spent might be a question mark, but equally whether 5 billion was way too low and we were underspending on things like infrastructure and hospitals and schools, etc., I think is quite a valid discussion and valid criticism of previous governments in New Zealand. But broadly, again, a very long answer to your question. I think despite a lot of the media discussion, is they like to sort of throw large numbers about and and just point to the number without putting context. And from that point of view, I don't think New Zealand has a debt problem per se. It's probably a question as to how it is being spent rather than the quantum.
The perennial productivity problem.
Correct. And again, that's probably one reason why we don't have the productivity that you have in places like America. And whether we like to acknowledge it or not, one of the, you touched on at the start, something like AI is potentially going to be a remarkable productivity boost to places like that. And I think countries like New Zealand need to move on to that as quickly as possible.
Yeah, the gap will just grow if we don't grab the opportunities when they come. Okay, so in New Zealand, what do you think will be the catalyst for the worm to change, turn a corner, as they say? Is there anything that you see in the horizon locally that was going to or we just need to work through it?
Look, I think there would be two answers to it. One, markets are good at pricing in what is out there now. Well, I shouldn't say now. What is in current expectation? So again, come back to that point. Where could we be surprised? Yeah. Do we think the market would be surprised if growth was slower than expected? Frankly, I think not. I think the surprise comes if actually we get some green shoots, some positive news. And I think that could be the catalyst. The other one is that at a business level, or even think of at a personal level, interest rates have been high. Growth and activity has been slow. What does that mean? Generally means, companies are getting leaner. They've been cutting costs. They've been making themselves more efficient. And in that situation, when you do get a more positive outcome, they will actually potentially benefit more than they would have otherwise. So you actually get more ability to earn. You've taken out that sort of additional spending. So from that point, I think there's that. And equally, given a lot of the New Zealand economy's been at or about zero for a couple of years now, there's got to be in different pockets. I'm not saying every area of the economy will be strong, but there are pockets where there will be demand, where things haven't been as bad as expected, and that pocket of demand, be it infrastructure, be it capital spending on the part of business, I think could again be the catalyst to push things forward.
Over the weekend, it's fair to say that tensions in the Middle East grew quite a lot.
Significantly, yeah.
What do you think this will mean for financial markets? And should global investors be concerned about, I guess, it escalating into a regional conflict rather than a more localized one?
Yeah, I think concerned is probably the right word. But as always, again, not meaning to be a broken record, but markets respond to surprises. And yes, at the margin, it's a negative event. Who would expect this morning? Generally, markets had a difficult Friday and to be down today. But is it a major surprise? This has been going on for some time. It's an escalation. It's a spreading of that, but it's not a completely new event. So I think, does that create a sea change in perception and activity? No. I think it probably does weigh on things in the shorter term. I think the other one is, again, also sort of thinking about what is the impact that it might have. Yes, if you end up with a full regionally wide war, that's a big issue, and that will take focus and be negative for markets. But I think, again, if you sort of think about the drivers of global growth, yeah, is US growth or is European growth going to be particularly dented by activity in the Middle East? No. And I think one of the key reasons for that, certainly many older listeners will think back and sort of say, well, what about the oil shock of the 1970s and all of that issue? The simple fact is that oil is far less important these days. I think again, you probably don't want to focus just on the US, but information and data is always easy. In the US is now self-sufficient in oil. They don't need Middle East oil. And in general, relative to the 1970s, the global economy, the intensity of oil usage is about 65% lower than it was in 1970. And, you just think about, the efficiency of your car, or, potentially in 1970, you may have had an oil burner or something like that. You don't have those these days. So the usage is just lower. So maybe I'm being too optimistic, but, hopefully, and in initial answers would suggest maybe this is a little bit of aggressive saber rattling is probably the right way, and that maybe it stops here. Hopefully it stops here.
Okay. And then geopolitics is always something that's hot on the minds of investors and clients of ours and more broadly. A common theme is this concept of, the impact that an election can have. And I did some numbers, and I think we've got around 2 billion voters this year who will be going to the polls. And that includes India, Indonesia, the US, and Mexico.
And Russia.
And so the idea that elections can significantly influence one way or t'other the direction of financial markets. What's your take on that? And how are you foreseeing the risks attached to elections for financial or investor outcomes?
Yeah. Elections, by definition, take focus in terms of, you saw that here. There's a lot of focus on the election last year. And it often causes people to, or sometimes, may cause people to pause. And it creates uncertainty and noise, and does create a bit of volatility in markets generally. But one interesting thing is, again, trying to think about going back to the data and saying, what does the data actually tell us? And, again, I think I've mentioned this on the call before, but work by Fisher Investments out of California, who we work closely with, one of our external managers. Work they've undertaken looks at the US election cycle, which is every 4 years, and a strict 4 years, because there is no early election ability. And despite the noise and despite the uncertainty, since 1925 or 1922, election years are more often they are positive than a random year. So in general, I think a share market in any given year is up about 59% of the time. In a US election year, it's actually up 83% of the time. So just because it's an election doesn't mean it will be a positive year, but history tells us often it can be positive. And part of that is really, I think, a reflection that, governments at the end of the political cycle are either hamstrung in terms of what they can do. In the US, you have midterm elections, and generally the president loses control of the Senate or Congress, so that makes it difficult to pass new legislation. Or, frankly, they've done a lot of what they intended to do early in the cycle. New Zealand is a good example of that. You have a government which has things it wants to do and is getting on with it now. So generally that means it's sort of back to, I suppose that normal situation. You end up with actually quite a normal economic year, and they tend to be good for markets. So from that point, I think that would actually make us, it's a brick in the wall for us, and part of the reason why we've generally been positioned positively. The other one would be that, again, coming back to that idea of what's not in price, something as a random thought, and no strong views on this, but in the US with Trump potentially getting in, he won't be as positive in terms of funding wars elsewhere. maybe does that create a situation where Ukraine and Russia actually makes a ceasefire more likely? That would be a positive event, which is not necessarily on people's radars at this point in time.
Yeah, I always and this is have read around this sort of psychological concept of certainty being so critical for businesses, and when in the lead up to an election, there's a whole lot of uncertainty around the different visions for the future, and then whichever way it goes, you do get more certainty than before, which enables particularly businesses and investors to respond.
Yeah, it's probably worth saying something that I haven't touched on yet. Generally, for the last year within share markets, we've been across all markets actually, we've been positive and we wanted to be fully invested. And I mentioned we've been over invested in shares. Given the positive run in the very short term, we have taken that back to essentially, just a flat invested. We've put a little bit of downside protection into the portfolios, just in case any of these issues like the Middle East, etc., have come up, or just the fact that share markets have run pretty hard over the first start of the year, and often the middle of the year, whilst not necessarily negative returns, aren't as strong as the front or the back of the year.
Last question. The first quarter of this year, and we get a lot of questions around this asset class from clients, and a lot of clients particularly interested in it, and the fact that we are open to having a small allocation in our portfolios, a complementary allocation to digital assets. And over the last quarter, we've had a strong run in particularly Bitcoin. And take us through what's going on there just at a quick high level, and where are we at? Last time we spoke about it, we discussed ETFs and the fact that there'd been a greater institutionalization, it's a long word, in the US, and now we're further along the journey, and it has translated to some price outcomes. So where is it going, and what's happened in the last few months?
Yeah, I think again, probably start with some context. In terms of the broad swathe of cryptocurrencies, is that a new asset class or is it a currency? Don't know. Could be.
Or a commodity.
Well, I think that's where I was going. You stole my...
the funder's taken, sorry.
Exactly. We'd very much, and this is probably more the case for Bitcoin versus some of the other cryptocurrencies, but to us, Bitcoin has a lot of the aspects of a commodity, and in fact, quite similar in many respects to gold. And in that sense, again, I'll come back to that prior comment. A lot of commodities, their long-term returns are not up to those of shares over the very long term, and they are more volatile. So it says we don't want to have a large allocation in the portfolios through long periods of time. But they can have episodes, and quite long episodes, where because of demand and supply issues primarily, they can have very strong performance, so they can be a useful addition. We think about Bitcoin like that. Again, if you think about something like gold, it is a limited supply asset. For example, gold, I think clearly gold is mined, but there's about 3,000 tons a year. Compare that to copper that we were talking about before. There's 20 million tons of copper mined a year. So a very limited supply asset. And in that sense, if there is more demand, and there is actually more demand for gold at the moment, mainly from central banks buying them, that pushes price up. Move to Bitcoin. 21 million Bitcoin is the cap in terms of its structure. We're at sort of 19 and change, I think, in terms of Bitcoin in circulation. So there is a little bit being mined every day, every week, but it's still a very limited supply. And we've talked in the past about the ETFs. And the 10th of January, the SEC, the regulator in the US, approved exchange-traded funds, ETFs, to be able to own direct Bitcoin. And really what that means is that for an individual investor, or more importantly, an individual financial advisor at a large advisory firm like Charles Schwab or Fidelity or Merrill Lynch or somewhere like that, it gives them an ability to buy Bitcoin in the same way they would a share. Easy, a known structure, they know how to hold it in custody, etc. So that gives them that ability to do that. To put it in perspective, those advisors in total oversee about $30 trillion of assets. And typically, those clients will have a 0% allocation to Bitcoin. So even if there is a 1% allocation across that client base, that's $300 billion. Broadly, in terms of market cap, Bitcoin's about 1.1, $1.2 trillion. I'm not sure the exact number today. But you're looking at demand, which is a third of its total value at the moment. So again, coming back to our views, we do view something like crypto, which we have in the portfolio, as a commodity. And there seems at the moment a very clear demand-supply imbalance from that point of view. And that's also one reason why sort of Bitcoin is the best performing asset in many respects over the last year. I think it was up, what are we up? 1 year where Bitcoin, I don't have the year to date. I've only got the year to date change, and that's up 50% this year. So, and six months about 135%.
Yeah, I mean, obviously investors will be thinking about the future, and some people might have been buying in advance of it and so forth. But
so what is in the price today?
What is in the price today? But if there is a big increase in demand, as advisors become more comfortable adding it to client portfolios, that will provide a whole nother wave of interest and additional demand.
Yeah, so again, I think from our point of view and the way in which clients would think about it, we very much view it as a commodity. We think it's got an ability to be owned at the moment because it's under-owned generally and there is demand. But as a long-term asset in the portfolios, no, I think if price, say for argument's sake, price was another 100% higher, would we own it at that point? Don't know. Would we own it? May we not own it for 3 or 4 or 5 years? Absolutely. I think it's definitely the case. Yeah.
Fantastic, Mark. Thank you very much for your time. I look forward to having you on the call again, sometime again soon. And have a good week, everyone.
Thank you.